If you're looking to make some repairs, maintenance, or improvements to your investment property, then you need to listen and listen carefully. Hey everyone, Tuan from DuroTax here with another video designed to help you become a better property investor. While these three things are very similar, they're treated very different by the ATO. We see first-time investors who aren't equipped with the necessary knowledge get caught out with missed opportunities to claim these expenses and how best to claim it. In a recent review, the ATO shared that at least 9 out of 10 property investors were making mistakes on their claims when it came to claiming expenses on rental properties. So today, I'm going to be showing you how to distinguish between repairs, maintenance, and improvements, and how these can be used to claim for the best tax benefits. You'll want to stick around until the end so that you don't miss out on understanding how each type of expense is treated differently. I'll also share with you a handy chart we've created just for you. Before we get into it, we want to be clear that this video is for informational purposes only. In no way should you interpret this as tax advice. We always recommend working with a qualified accountant or a tax agent who can give you the best advice for your situation. So let's start with repairs. The ATO defines repairs as fixing a defect or damage to your property. In other words, repairs are related to the general wear and tear of the rental property, as well as any damage caused to the property as a direct result from renting it out. For example, replacing roof tiles that were damaged in a storm, repairing a broken air conditioner, replacing a broken window, or having to reseal a leaky bathtub. Generally, the items being replaced must be the same or of similar specifications to the original one. So what about maintenance? Maintenance work is any work that's carried out to prevent deterioration in the property or to fix already existing damage. So things like pest control, painting, cleaning, or gardening itself is considered maintenance. That leaves us with improvements. So while a repair restores something to its original state and maintenance prevents the property from deteriorating, an improvement upgrades the investment property. This usually means that you're looking to do this if you want to increase the market value of your property or to increase the ability to generate even more rental income. Some examples may include remodeling the kitchen for it to be bigger and more spacious, replacing the damaged carpet with superior carpet to the one that was originally there, replacing the carpet with timber flooring instead, or adding a swimming pool perhaps, or perhaps landscaping to the property. So that begs the question, of the three types I just mentioned, what can you claim on your investment property then? The answer is that you can claim repairs and maintenance as immediate tax deductions. In other words, you can claim these expenses in the same year that you paid for them. But before you go out and start these projects, make sure these have been done during the period you're renting the property out. So what can't you claim on your investment property? Well, you can't claim any of this stuff if it didn't occur when the property was rented out. For example, for initial repairs that you've made right after acquiring the investment property, you can't claim as a tax deduction under repairs or maintenance. For example, if you needed to replace the shower, repair the air conditioner, or even repaint the walls in the house, these are considered a capital expense. This means that you have to add this to your cost base, and that is used when you're calculating capital gains or losses when you sell the property. At DuroTax, we have specific reports called capital gains reports that are specifically designed to account for all these capital expenses and improvements so that you're fairly paying for the right amount of capital gains tax. For completed works that have not been depreciated and may lack the supporting documents to claim deductions, these also can be added to your cost base once they're assessed by the quantity surveyor. The same rule also applies to improvements made to your rental property. These are also considered capital expenses and form what's known as capital improvements. Capital improvements can claim 2.5% of the cost each year for up to 40 years from the date that the improvements or initial repairs were made. Our tax depreciation schedules are explicitly designed to provide you and your accountant with an accurate estimate of capital expenses so that you can claim it on your tax return each year for as long as you're renting the property out. Beyond this, you might also be wondering about how it all works when you need to replace something that's beyond repair. Well, the ATO doesn't consider this as a repair, and it means that you need to also claim it as a capital improvement and therefore a depreciating asset. So there you have it. For you to be able to claim repairs and maintenance expenses immediately, these need to be directly related to wear and tear while you're renting out your rental property. Meanwhile, improvements aren't immediately claimable, but you can claim it over time as a tax depreciation by engaging a quantity surveyor like us at Duotax. So if you want to check out our chart, you can head over to our article in the description box below. And if you know a friend, family, or colleague that needs to hear this, be sure to share this video with them so that they can take advantage of tax depreciation on their next rental property. If you're still not sure, or you just want to engage a quantity surveyor to help you with this, then get in touch with us here at Duotax today. My name's Tuan Duong. I hope to see you next time.